Hello and welcome to Eye on the Money, the show that gives you insights into how to improve your financial well-being as well as make your money work for you. I'm Ingrid Nantege. Today we're going to look at how as a borrower you can negotiate for better interest rates. Now, President Uhuru Kenyatta recently signed into law the Finance Bill 2019. The Finance Act 2019, among other provisions, repeals Section 33B of the Banking Act that provides for the capping of bank interest rates. The repeal of Section 33B of the Banking Act is expected to enhance access to credit by the private sector, especially the micro, small, and medium enterprises, as well as cut out exploitative Shylocks and other unregulated lenders. However, it also gives banks the liberty to set their own lending rates, which could result in exorbitant interest rates charged to the borrower, the main reason the interest rate cap was instituted in the first place. Joining me in studio to help us understand how we can best shield ourselves from the high interest rates following the repeal of the interest rate cap is Esther Maruga, the Acting General Manager of Metropole Credit Reference Bureau. You're very welcome to the show, Esther.
Thank you so much.
I'm always happy to have you here.
Thank you.
Are you feeling at home because you're at home?
Sure, I am.
So, Esther, today you're here to help us understand the repeal of the interest rate cap. So there's been a very heavy conversation around this, especially most recently. There's been a lot of back and forth, but finally the decision was reached. The interest rate cap was repealed. Initially, in the first place, the reason it was put there was to, help protect the borrower, just enhance access to credit. But now that it has been removed, what should we expect? What will be the repercussions in your view?
Okay, thank you so much again, Ingrid, for having me on this show. Maybe we can start by putting the interest rate or the capping into context.
Perfect.
Why was it introduced? So it was introduced to protect the borrower, to be able to access credit. But we have what we call unintended consequences of the interest rate capping. So what we saw is, and this has been even been on the KBA, the outline that they have put, that 1.2 account, there was a decline of 1.2 accounts in terms of the loan that were opened within that period. The other thing is that 45% increase of the borrowers who already had loans, meaning the banks were just lending to those who already have accounts or have loans. So what that meant is that we actually locked out the SME, the small mwananchi, the mama mboga, as we put it, from accessing credit. So what the interest capping is coming, and by the repeal of the interest capping, what we'll be seeing is access now to credit. The question is, after you access the credit, at what interest rate are you getting this loan for? So what will happen is that the market now, the interest rates will be determined by the market dynamics. So the market forces will say whether you will borrow at this level or at that level, which is the interest rate now. So what will happen is that the banks now will need to come in and provide innovative products that do not lump all the borrowers at the same band. Because with the interest capping, everyone was getting interest rates at the same rate, which was 4% from the CBR rate. So what will happen is that we expect the market now to expand, to be able to look at this borrower, profile their risk levels, and attach an interest rate to the borrower. That means if you are a risky borrower, you will be charged more by the bank. If you are low risk, then you expect that the interest rates will be lower. So if you look at the consequences or what some of the repercussion is that positive repercussion of interest rate capping is access. The market now will expand. The banks now have an opportunity to come up with innovative products that they can be able to extend to the borrower. On the downside then, it means that the borrower will be susceptible now to high interest rate. What will happen is that the borrower now needs to understand what are the terms and conditions that I'm getting myself into, because it was pretty obvious. If I had a loan, I knew the interest rate that come with it. But here now, there's a responsibility of the borrower to get to know what is this interest rate that I'm being charged, which now will help us to open up the market, where you have the banks, and the banks were limited in terms of where the borrower that they consider as low risk, because if you cannot be able to stretch your margins in terms of getting a profile of a borrower who will actually pay you, it means that the risky borrowers had no opportunity even to come into the bank and get a loan. So it's important for the borrower to ensure that they get to know what terms would the banks be giving me in terms of the interest rates. Yeah.
That's a very good picture you've painted there. Now, you've mentioned that with the repeal of the interest rate cap, then we're left in the hands of the market forces. My next question then will be, does the market have the capabilities to ensure then that the interest rates don't over balloon? Is there a situation around that, and how does that happen?
So one of the things, because banks are in business, and because they're in business, they want to lend, and once they lend, the customer pays and pays together with the interest, meaning that they have the intention is that the moment they disburse the loan, this customer will pay. But the biggest challenge is that whether the customer will pay and whether they will pay on time. So the issue of non-performing accounts then appear or come into play. So we are looking at the risk level of this borrower and saying, if I'm a bank and I have customers, can I be able to ascertain whether these customers will pay and whether they will pay on time? If I'm able to ascertain that this customer will pay, it means that I have evaluated the risk. And what is the risk here? The risk here is an outcome that the expected outcome is different from the actual outcome. And in this case, if you lend, you expect that the customer or the borrower will pay you. So if they don't pay you, you're already at a risky engagement. So we are saying that the banks will be looking at a customer and looking at this borrower and saying, will this borrower be able to pay me? So they have to put in capabilities or come up with initiatives to be able to ascertain how do we predict that this customer will pay back. One of the things is the credit information sharing. When you have the CRB, on the CRB we keep information about the borrower. This is what we call the payment behavior. So from the payment behavior, then we are able to come up with what we call probability of default. Are we able to look at your past payment behavior and predict how you'll pay, which now determines your credit worthiness. So the credit worthiness then becomes very important for the bank to evaluate the risk level of the borrower. Other than the credit worthiness, the banks will also put in place other what we call other requirements or other attributes that they'll be looking at for the borrower who meets that threshold. For instance, they will have issues with loan to value ratio. So on the loan that you are borrowing, the amount that you're borrowing, what is your investment? Say for instance, there's a house you want to borrow to invest in a house. What is the contribution for you as a borrower? Right. Maybe it's an asset finance, you want to buy a car. What is your contribution to that car in terms of your investment into it? What have you put in as you go to the bank to borrow? Is it additional amount or is there your own contribution? The other thing the banks will be looking at is the debt to income ratio. What is your income level versus the debt that you have accumulated or the debt that you have, so that then they're able to say if they lend to you, then you'll be capable of paying back. The other thing that you find the bank looking at is also your stability, what's the employment income, what other income streams do you have. We also have other simple characteristics of your stability in terms of where you live, in terms of where you're a business owner. Those are characteristics that can be able to help the bank to determine what is your risk level. Then also we are in an environment of big data and analytics. So the banks will come up with algorithms that will be able to determine what are your risk level. Based on the transaction data that you have, you've been banking with the bank. You also we have transaction data that they have accumulated. Then of course we'll be combining that with the credit information data which they can get from the CRBs.
Esther, just to dwell a bit on that point, and just for purposes of clarity, you've touched on it, but then in the past we've seen a situation where some borrowers have been locked out on account of non-performing loans. Should we expect the situation to change, or like what do you think is going to happen for now in the reality of the repeal of the interest rate cap, especially to that particular category of people who've been locked out, you know, like I said, because of non-performing loans?
When you are locked out as a non-performing, it's because you have a non-performing loan. It means that you have an account that you're not paid, and with the prudential guidelines here, we are saying that you haven't paid that account for 90 days. So that's already a red flag. And as I say, the banks are in the business, they're actually in business. So what does it mean? That even if they extend that credit to you, you will not pay back. So the question is, do you have other positive accounts that are able to outweigh any negative component, say, on your credit report? Because what will happen now is how the banks evaluate your credit worthiness. If you have a non-performing account, you become very unfavorable for any financial institution to actually lend to you, because you are already considered a high risk. And if you are high risk, then you find that the banks are likely to come in and actually look at reconsider your loan. So we will say that based, of course, the business processes, you already a high risk, and it will be unlikely for you to get a loan. So the most important thing, if you are a borrower and you have a non-performing account, is start making good your credit report, right, your credit score, start improving it, so that then you become favorable to the banks as you go out there to look for a loan. Then you become a favorable customer, because that's what the financial institutions will be looking for. Yeah.
Thank you very much for coming on to the show, Esther. You're providing valuable insight. Don't go anywhere, because when we come back, we're going to talk so much more about what borrowers need to do to shield themselves from high interest rates in this interest rate cap repeal era. I will take a very quick break, but don't go anywhere, because when we come back, we have so much more for you on Eye on the Money. However, you can keep the conversation going on our social media pages at Metropole TV KE on Facebook, Instagram, and Twitter. We'll be right back.